Here are my top 7 stocks to buy right now. We'll switch between one stock that I own followed by one new stock to keep it interesting, starting with a stock that's up 72% year to date and ending with a stock that's up over 4.5 times over the past 5 years, but might have room to double again. As always, we'll start by showing my actual stock portfolio, which has reached a worth of $215,000 and currently holds 12 total positions. And yes, I did switch over from using Charles Schwab, which shows I'm up 21% for the year, to a new app called GetQuinn. And as we go through each of these stocks, I'll be showing you exactly how much money I either made or in a couple cases lost in each of these investments. Some of which have made as much as a 40% return and $6,500, and one even made me $23,000, a 174% return in around the last year. So the first stock is an AI stock that has increased 65% year to date, but unlike most AI stocks right now, they're delivering real value which could double or more their stock price in the relatively near future. So Palantir is an AI company, but unlike a lot of other AI companies in the market right now, they're not just hype. They're actually delivering real, tangible value to their customers. Their customers, which mostly tend to be highly secretive organizations like banks, hospitals, the US military, and even agencies like the CIA. So I'm gonna go over 3 pieces of this stock. First, what is their AI technology? Second, what is their secret weapon that is causing them to grow so quickly? And third, do their actual earnings numbers back up all the hype around this stock right now? So a lot of the growth around Palantir recently has come from AIP, their AI platform. I recently did a deep dive into AIP to really get a good understanding of what makes this company different. So most AI companies nowadays are kind of just building advanced chatbots. They make it easier for people to interact with computers and for computers to talk back to them, but that's really all they're doing is kind of a translation service. Palantir, on the other hand, is using AI for decision making, but not in the way most people think. The way they're doing this is by using their secret weapon, which is their platform called Palantir Foundry. Foundry is basically a super powerful data analytics tool. Palantir will go to one of their customers and gather all their data into one place, basically all the disorganized PDFs, emails, and databases, and put them behind a single pane of glass. But then they will actually manually turn this pane of glass into what's known as an ontology, which is effectively a really well organized set of data that shows both the data and how the data all connects together. They then combine this ontology with their AI technology so that the AI basically becomes like a super smart employee. Palantir's AIP is around as intelligent as a traditional AI like ChatGPT, but the difference is ChatGPT is like a new college graduate, while Palantir is like someone who's worked for your company for 15 years and understands all the ins and outs of your data. Which, to super simplify, basically means that Palantir, once they get into a company or an organization, is very, very sticky and is able to unlock incredible value for those companies, which we can very clearly see in the company's earnings, where their US commercial revenue grew 40% year over year, with overall revenue, including slow-moving government contracts, rising 21% year over year, and the company achieving their 6th consecutive quarter of GAAP profitability, raising the possibility that Palantir could be added to the S&P 500 later this year, which usually results in a short-term bump in the stock price. So I currently own 450 shares in this company worth a little over $12,000, and it's made around a 23% return in the couple months that I've owned the stock. And by the way, if you want to try out this platform and some of these portfolio tracking features, GetQuinn has been nice enough to sponsor this video, and you can sign up and try out these features completely free using the link in the description. It's a lot easier to use than Charles Schwab was, plus I can just import all of my different accounts directly into here, so it makes it really easy to set up. So okay, Palantir may have made over $2,000 in a month, but that's nothing compared to the last stock on the list that has increased 450% over the past 5 years. But first, we have my best performing stock of the year, which GetQuinn tells me has made me over $23,000 since I've owned the stock. So this stock is an AI company that's growing even faster than their competitors in one of the most important industries of the next decade, cybersecurity. So Crowdstrike is a stock that I've owned for a couple years at this point, and the reason for that is they are the leader in AI-powered cloud security. Now this stock has gotten quite a bit of publicity recently. The stock price actually declined almost 18% in the past 5 days, largely driven by them accidentally causing what is being called the largest IT outage in history. Basically, CrowdStrike pushed an update that ended up causing Windows computers to show the blue screen of death, bringing down computers in Times Square, at grocery stores, airports, and train centers across the entire world. Now, this has already caused a short-term dip in the stock price, but in this video, which was filmed before the outage, I'm going to be focusing primarily on their long-term strategy because I don't think that is going to have changed as much. And I'll be making another video next week focusing on CrowdStrike more in the short term. So IT outage aside, CrowdStrike's products are very different from a traditional security company. Traditional security companies were built with traditional companies in mind, companies that ran all of their programs directly in their office building. We now have generative AI created viruses, and simply comparing a potential virus to a list of previous viruses isn't enough. What CrowdStrike has done is create what they call their threat graph, which is basically a massive database of every virus or hack that has ever occurred, which they can then point machine learning models at to understand the patterns within hostile software. Rather than memorizing previous attacks that have happened, they look at patterns of attacks so that they can prevent new attacks in the future as well. This company is absolutely taking over in cybersecurity. Gartner ranks them in the top right magic quadrant for endpoint protection, they're in the top right for cloud workload security, and they're in the top right for risk-based vulnerability management platforms. So aside from this being an incredibly well-performing stock who has increased 50% in the past year, and aside from the fact that this is a company that grew their revenue 33% in their most recent quarter and is now net income positive, meaning they're making a profit. But my main thesis for investing this stock is just how well positioned they are for the future. The overall cybersecurity market is expected to grow at a compound annual growth rate of 9.7% going forward. And cloud security specifically is growing way faster than that, where it's expected to grow at over 26% per year through 2029. And in a report from Moby, they note how the company invests around 20% of their revenue back into research and development. And this commitment to continually improving their technology and not just taking the short-term profit is one of the reasons that CrowdStrike is able to stay ahead of the curve when it comes to tackling new cybersecurity threats. And it's also the reason that clients love their platform so much. In fact, at this point, 64% of their clients use 5 or more modules within CrowdStrike's platform. So CrowdStrike can basically land a new customer with one piece of technology and then upsell them onto 4 more pieces with an extremely high level of reliability. So when the AI market eventually cools down, in the long term, I believe CrowdStrike will weather the short-term storm and become one of the top companies left standing in this market, which is why CrowdStrike is still my single largest position even after the recent dip. But at this point, you might be saying, wait a second, does this guy only invest in tech stocks? Well, GetQuinn actually ran an AI analysis of my portfolio. It's one of their premium features, and they said my portfolio ranks higher than 68% of other users, but there are some areas that I can improve. The biggest one being diversification, showing how I'm very highly exposed to USA stocks specifically and way exposed to IT stocks. So because of that, let's talk about a non-tech stock for stock number 3. So this is a stock that I first talked about a couple months ago, and the stock price has since increased 37% over the past year. And the reason it came to my attention is because Warren Buffett was quietly buying up billions of dollars worth of this company without telling anybody what it was. This stock plays in one of Warren Buffett's favorite areas to invest, the insurance world, which makes sense because insurance companies tend to last a really long time and throw off a ton of cash flow, which Warren Buffett is a huge fan of. Look, we have insurance companies in the United States that have been around for nearly 100 years. In fact, we have some insurance companies that are even older than the US itself. So the game when it comes to investing in insurance is to simply find a stock that is undervalued and hold for a very long time, which is what Warren Buffett is trying to do with the Chubb group of insurance companies. So Buffett first began buying this stock in the 3rd quarter of 2023, and the now $6.7 billion investment has now become his 9th largest holding inside of Berkshire Hathaway. So the reason he bought this stock is mostly because of this guy, Todd Combs, who is the CEO of Geico, one of the biggest insurance companies in the US, and who also happens to be the investment manager of Berkshire Hathaway. So it's someone who has a ton of experience in the insurance industry. industry. So for this stock, the numbers are everything. So I'm going to open it up here on Stockopedia and look at some of the metrics around this stock. They currently have a PE ratio of 11.4, which puts them around the middle of their specific industry of insurance, but puts them on the cheaper side for the overall stock market. But if we look instead at their PEG ratio, which factors in growth, the stock doesn't look quite as strong. And if we look at their price to tangible book value, which is a metric that basically measures how much is the stock worth above just the raw assets of the company, we can see it's at 3.07, which makes it one of the most expensive companies in the insurance market that there is. This indicates that the market is willing to pay a premium for this particular stock, which may come down to the fact that it is the largest publicly traded property and casualty company, and the fact that this is a company that has done a really good job of basically issuing insurance, posting an underwriting profit annually since their current management took over around 2016. It's not flashy, it's not inventing some new technology, but basically they've worked better and been less volatile than their average specialty insurance company, and so the market is willing to pay a premium for that. And considering Warren Buffett has just put a bunch of money into it, it's probably a relatively safe bet going forward. But let's now pivot from the slow and steady Warren Buffett stock to a company that I think is going to be the biggest winner in AI going forward. So I see basically three types of AI companies that will actually make money. At the bottom level, you have the AI hardware companies. These are stocks like Nvidia that are already seeing a massive rise in valuation. At the top layer, you have the AI application stocks. These are companies like Palantir that are actually applying the AI. But then in the middle, you have the AI model creators, which is who is actually creating this market in the first place. We've seen companies like Microsoft, who partnered with OpenAI to create ChatGPT, see a 225% increase in their stock price over the past 5 years, which is insane considering this is a $3.3 trillion company. But I think Microsoft at this point is already fairly valued compared to Google, which is the other stock that is massively investing into this space. Google over the past 5 years has increased almost exactly the same amount as Microsoft, up 225% over the past 5 years. But year to date, they're actually outperforming Microsoft, up 33%, despite the fact that they currently have a lower valuation than Microsoft overall, both in terms of their market cap as well as their PE ratio, with Microsoft having a PE ratio of 39 and Google having a PE ratio of only 29. Now, Microsoft got an early lead in the area of generative AI because they made the massive bet in buying 30% of OpenAI, the company that created ChatGPT and GPT-3. But the reason they did that in the first place, internal emails have now revealed, was triggered by fears that Google was going to get too far ahead of them in the AI space. You see, all the big tech companies at this point, Amazon, Microsoft, Google, run their own cloud platforms where they make a ton of money. Pretty much any website or application that you use runs on one of these cloud platforms called the hyperscalers. Amazon is the biggest, but Microsoft and Google have been competing for spot number 2. And while Google has historically been a lot smaller than Microsoft, they've been better in one specific area: AI. But when ChatGPT stormed onto the scene in 2021, Google was caught somewhat unawares, and then Microsoft took the spotlight from them in the AI space. But Google has since been catching up. OpenAI and Microsoft, by extension, launched GPT-3.5 in 2021, along with ChatGPT, which introduced the world to generative AI. But it took Google quite a while to respond, launching their version of generative AI, Bard, in February of 2023. They were almost 2 years behind at this point. Then OpenAI continued to innovate, launching GPT-4, and then in May 2024, launching GPT-4o, which can understand not just text, but also images. Google responded by launching Gemini in February of 2024, but then in mid-February 2024, they launched their latest generative AI version, Gemini 1.5, which has basically all the same capabilities as GPT-4o. So for example, I could take a screenshot of Alphabet's stock price and load that directly into Gemini and ask questions about it. And now Gemini, like the latest versions of ChatGPT, can tell you exactly what information is in that image. So Google's gone from being around 1.5 years behind OpenAI to being basically neck and neck with OpenAI just 2.5 years later, which indicates that Google is moving faster than Microsoft in this space, which is a really big deal because once Google can get customers to use their AI, it brings them onto Google's cloud platform, where Google can then upsell them onto the real value valuable AI that they produce. Traditional machine learning, computer vision models, speech to text. All this AI that Google's been creating for the last 20 years is still valuable. ChatGPT doesn't solve all of it. And that's where the real money is going to be made. Whoever can convince the market that they are the best partner for AI is going to get the majority of enterprises to work with them. And because Google has so much room to grow in terms of cloud market share, they stand to benefit the most from grabbing those enterprise customers and getting them inside of Google Cloud. And remember, machine learning and AI means data. And if they can get access to all these enterprises' data, it's very hard for those customers to suddenly switch and go to a different cloud provider. Oh, and I mentioned that Google kind of fits into the middle of that AI tech stack. Well, the company is also starting to work on creating their own AI chips. And right now they're mainly focused on the consumer division, but I would watch this space because remember, their big play here is enterprise AI. So what are the odds they don't one day launch an enterprise-ready AI chip for a data center? In total for Google, I currently have $22,500 invested, which has increased 40% and made $6,500 overall. Oh, and GetQuinn will also automatically pull in any dividends that I'm getting paid out and will forecast how much I'm going to be paid out in dividends in the future. So obviously I don't hold a ton of stocks that are issuing dividends, but if we were to look at a portfolio that has more dividends coming in, we can see how GetQuinn automatically tracks which companies are paying out how much in dividends over time. It shows both how much you've made in previous years, and it will actually forecast out how much money it expects you to be paid in the future based on the stocks that you hold, which would be really useful if you're trying to forecast out how many dividend stocks you need to hold to, for example, live on. The other really cool piece here is how they let you track your performance over time. So they'll break down your performance compared to how much you've invested versus how much you've made in profit, but you can also look at this in different views. Aside from the bar chart, I can jump over to a normal line graph, or I can do my favorite view, which is this heat map view. So in this view, I can actually see the years as rows and then the months as columns. So I can see, for example, if April, my stock portfolio has always underperformed, or I can see months like June and July where my portfolio tends to perform better. A view like this could be really useful for investors because it's just not something that most tools are going to give you. So let's look at stock number 5, which is one of my few stocks outside of North America, but it has increased by 65% year to date. So the whole thesis of this stock centers around the growth of Latin America, which if we look at my allocation by region here, we can see how much smaller that is compared to my North America investment. But specifically, this company is focused on investing in the future of Brazil. So the World Bank classifies Brazil as still a developing country, but they are a massive country with 203 million people with an average GDP per person of $8,800. But what's interesting about Brazil specifically is they're kind of like the United States in that they're actually sort of a mishmash of a lot of different cultures, histories, and races. But for our purposes, what's really interesting about Brazil is that the B2B fintech segment in Latin America has been growing incredibly quickly, with 66% of this growth occurring in Brazil. Basically, Latin America is a hotspot for fintech investment and has been since 2018. And according to investment figures so far as of May, investments have reached $400 million this year, which means this may be their highest year yet in terms of fintech investment. And there's one company in particular that is leading the way. Nubank is a banking app that primarily focuses on Brazil, but they're also a shopping app, and they're also teaching new businesses how to run their businesses more efficiently. While it's not as common in the United States, Nubank is a super app, basically an app that can run pretty much every aspect of your life, from ordering groceries to running your banking. And because of this, this company has now reached 100 million customers as of May 2024, generating revenue of $2.7 billion and profit of $379 million. This is a really big deal because the company has grown 79% year over year in terms of their revenue and 167% in terms of their net income, with a current run rate on pace to make over $1 billion in profit this year. So there are two big opportunities for Nubank in the near future. The company is continuing to grow incredibly quickly. They added 5 million customers in just the last 3 months, and over the past year, they've added 20 million people to their platform. So with this incredibly large user base, the company can begin to monetize them by offering offering more products and services to their existing customers. This will allow them to effectively increase the amount of profit they make per customer they need to market to, which should drop straight to the bottom line. And the second opportunity is for Nubank to expand outside of Brazil and into other international markets. Nubank is already the fourth largest financial institution in the entire country, but they've recently started to focus on expanding into Mexico, where they saw nearly 1.5 million new customers added in the quarter, which means they're now up to 6.6 million customers in the country, a pretty big increase from where they were just a couple years ago. So anytime you move into a new company, there's going to be growing pains. There's a fundamentally different culture that you have to appeal to, and the specific needs of that country will be different from in Brazil. But what's really exciting here is Nubank is moving faster in Mexico than they did when they first launched the product in Brazil, meaning there are efficiencies that they learned in their first period of growth that they're able to transplant over into Mexico. Now, it's still fairly early stages for this movement into a second country, and after that, we'll still want to see them expand across the globe to start competing with every country. But based on the initial results we're seeing so far, there is some evidence that they may be able to compete at a very high level here. So for Nubank, I currently have $16,000 invested, and I've made over $5,000 in this company, which it's massively under talked about. But now let's move to a massively underrated stock, which probably won't show up on GetQuinn's list of trending stocks anytime soon, but I think could arguably have as big of an impact as the Teslas or the Nvidias of the world over the next decade. Cloudflare is working to make the internet itself work better. They were originally born out of a very simple problem back in 2004. How do you stop spam emails from coming through? The company then evolved to protecting entire websites with their technology called Project Webwall. And after him and his future co-founder got their MBAs from Harvard Business School, the three co-founders moved out to California and began building Cloudflare's first big product. One issue the company ran into, though, is when they were protecting the websites, they would often end up slowing the website down. So they became obsessed with trying to increase the performance of websites. What ended up happening next was a little surprising. Cloudflare launched their product on a small selection of websites to start, and they found that they were protecting those sites against bad guys, but the sites were also loading faster than ever before. It turned out Cloudflare not only solved the problem of offering security, they also offered performance increases. And from there, the company has been off to the races. This is one of the most innovative stocks that I've ever seen. The company continues to launch new products in different areas, both for securing applications, for connecting them better, and for providing tools to developers to be able to build new applications as well. At this point, Cloudflare has basically become its own cloud provider, which would have been unthinkable a decade ago when they were just a small startup that would have had to compete with the hyperscalers like Amazon, Google, and Microsoft. But compete they have. The stock is up 23% over the past year, but more importantly, the company's earnings have been rock solid, with their revenue growing 30% year over year to now over a $1 billion revenue run rate. And while the company is not yet profitable, they're only slightly in the negative, and more importantly, they are producing a ton of free cash flow. I've said before that I think cash is more important than profit, because with cash you have options. You can buy back the stock price, you can invest in creating new products, you can acquire your competitors. As long as you have cash, cash is like the oxygen to the business, and your business can continue growing. Well, profitability can often only show up on paper and not actually be used to grow the business. It's possible to go bankrupt while being profitable, but you're not going to go out of business as long as you're creating cash, which is why Warren Buffett is so focused on cash flow. So let's take a look at what it is about Cloudflare that'll make them worth more in the future than they are today. So the company has now reached the point when 30% of the Fortune 1000 are paying customers, and 95% of internet users are within 50 milliseconds of the network that Cloudflare has created. And this internet backbone that Cloudflare has created is now becoming the jumping off point for their incredible growth, which has resulted in a 46% compounded growth rate since 2018. And one area that Cloudflare has started moving to aggressively is cybersecurity. With the ever-increasing number of online threats, Cloudflare has moved into the zero trust security space. Basically, with traditional security, you have something like a firewall. It protects the outside of your business so bad actors can't get in. But if the bad guy does get in, they have free reign to mess with whatever they want. But with zero trust security, every application, every person, every computer on the network has to authenticate update anytime it talks to anyone else. And this is super important when you're building a network infrastructure like Cloudflare is. And with more people working from home or businesses running on the cloud, it's pretty rare that two computers are physically connected next to each other. So if you're gonna have two computers talking to each other, zero trust security becomes more and more important in the age of the cloud. Cloudflare just continues to launch new products that make their customers' lives better. And while this is still a relatively new area in terms of zero trust security, it is an area that is going to see a lot of growth in general. And based on Cloudflare's previous performance, I wouldn't be surprised if they perform very well in this field, which is why I currently own 162 shares in this company valued at just under $13,500, and it's made me $2,500 so far. Which leads us to stock number 7, a stock that has increased 450% over the past 5 years and yet still looks like a value at today's prices. This is an AI chip company that, unlike Nvidia, hasn't seen quite the same rise in price year to date. And by the way, this video doesn't cover all my stocks, so I'll be showing my full stock portfolio at the end of the video. So let's just compare some of this company's metrics versus Nvidia. So year to date, Nvidia's stock price has more than doubled, up 168%, while this company is up a much more modest 31%. Nvidia is also valued at a current market cap of $3.18 trillion, while this company is a relatively small $290 billion. And while this company does have a higher PE ratio, I'll get into why I don't think that's the best metric to directly compare these companies. So a big part of Nvidia's rise has been their early entry into the data center AI space. Basically, they make the best GPUs for running AI applications. And because of this, their data center revenue grew 427% year over year, a little bit under 3 times faster than their overall stock prices increased. This chip maker, on the other hand, has seen their data center and client segments grow 80% year over year, a relatively similar ratio of growth to stock price. While Nvidia has been very focused on the highest possible performance GPUs that they can charge a huge premium for, this chip maker is focused more on the budget-conscious AI developers, which up until now hasn't been an incredibly profitable area, because if you think about it, everyone is racing to make the fastest AI models possible, regardless of cost. So they're willing to pay a premium for a product like Nvidia's. But in the long term, most AI models are going to become commodities. They'll all be basically as good as each other, so no one wants to pay more for one versus the other. That means they'll need to compete on cost. This is the reason that many AI giants, including Microsoft and Google, are focusing on starting to build smaller, less powerful AI models that are able to offer solid performance but with less energy and less cost overall. These clients may actually benefit from a lower cost chip option, unlike those being offered by Nvidia. In fact, this company's MI300 series of GPUs are reportedly delivering stronger performance for AI workloads at a better value than Nvidia's pricey H100 chips. And given that the current investments in AI are unlikely to slow down anytime soon, and more companies are going to be pushing more and more of their applications into the cloud and cloud data centers, I think Nvidia is going to do fine, even given their high price. But I think AMD, at their lower current price and smaller market penetration, have more room to grow overall. So here is my full stock portfolio that I had promised I would share at the end of the video. I'll also share this on an Instagram post, and you can get a link directly to sign up for GetQuinn in the description below this video. Honestly, the tools here are so much easier to use than Charles Schwab, and you can also upgrade to their premium features like the ability to track your dividends over time, as well as that heat map view that shows how your performance has done over time in a bunch of different ways. So you can actually understand the data behind your stock account. So check out GetQuinn using the link in the description, and YouTube's AI thinks you'd really enjoy this video next. Trust in the AI overlords, I guess.